What's one thing you can do when you've been assigned 100 shares with a cash secured put and you're trying to sell covered calls, but the stock price has gone against you? Well, one thing you can do is reduce your average cost. And I'll show you an example of what I have going here. I've got this U for Unity software. I've got 100 shares out in this. And if I wanted to sell covered calls, it'd be tough because I acquired these at $35. Current price is $27.01. If I wanted to trade options here and I was trying to sell call, even if I went out 12 days, if I try to get my average cost of 35, there's really just no premium here. It's 1 cent. So what you can do is reduce your average cost by selling another put, and with this you can get a pretty good amount of premium. And if I just went close to the money here, the delta is 47, which is pretty high, but the strike price is 27, and I could collect $88 in premium. And so if I take the $27 strike price here and I add the $35 acquisition price that I originally got the 100 shares, that'd be 62, divide by 2. So that would make my average cost of acquisition, if I got assigned these as well, to 31. So if I wanted to then go sell calls, I could go to 31 and still make a decent amount of premium, and it wouldn't be like close to zero. I could go even further by doing sell put, and I could go down to, let's say 26. That's still a good amount of premium of 46. So if I took my original cost of 35 plus 26 is 61, divided by 2 is 30.5. So then if I wanted to sell calls, and I can go up to 30.5, make a pretty good amount of premium here. And that's better than nothing while waiting for the stock price to increase. Plus, if I did this, I was selling calls and I had 200 shares, I could do 2 contracts. So this would be a $26 premium. So I'm gonna go ahead and do this. I'm gonna do sell put. We'll go 12 days out, and I'm gonna go right at 26. That's a $46 premium. Strike price 26, the delta is 30, that's within my range. I'm going to go ahead and add this to my spreadsheet, so I'll copy this line. Today's date 3/24, expiration 04/05. That's 12 days out. Strike price was 26, delta is 0.3, and the current stock price is 27.01. It's a put, and the premium collected is 46. Go continue here, view order, and I'll go ahead and submit that. Got the same thing happening with another stock I owned. Here's SoundCloud AI. I've got 100 shares of this. I was assigned these at $9, so that's my average cost. And it's currently trading at 606. So if I tried to trade options here, I'd go sell, call, and I go like 12 days out. If I try to get my $9 price, I could still make a pretty good amount of premium, but I could make more by selling puts against this, and just going right at the money, collect $60. There's a high likelihood I'll be assigned this. So then if I had, that's $6, 6 plus 9, 15 divided by 2. That would bring my average cost down to 7.5, and I could sell calls against this, later on and collect a good amount of premium there. Plus I could do 2 contracts if this was the current case right now and make $60. So I'm gonna go ahead and do that right now. Sell put, $6 strike price, collect $60, the delta is 40. So these little base hit transactions, they all add up. Don't think that they're a small amount, every little bit adds up. This puts me over $1,000 for this month based on like a $20,000 account. I know it says I have a $30,000 account, but a lot of that is tied up into some stock that I've purchased. So I'm only really working with about $20,000 out of this $35,000 account size. So that's one of the techniques you can use to work with stocks that have been assigned. If you want to sell covered calls against them and the price has gone against you, you can reduce your average cost by selling another cash secured put and acquiring more shares at a lower price, and that will reduce your average cost of acquisition. Hope you got some good value out of this, and we will see you on the next one. Thanks. Bye-bye.